I welcome all of you here on behalf of SNN Company. So today we are here for this session. Let me just give you a quick brief. SNN Company is a leading accounting and management consulting firm that partners with businesses to tackle their problems in the businesses and come up with unique solutions. Today, we have seen that the leading problem today is about how do we send our children abroad, where to send, when to send, which country to send, what happens once we send them, how do we send money to them, what happens if they earn there, what happens with the taxations, what happens in terms of currency risk to hedge, so many questions. But yes, sending children abroad has become a very common trend. I believe out of 10 children, at least not less than 2 to 3 are seen planning to go abroad for studies. So let us understand today a 360-degree view, a wholesome perspective on where, when, how to send these children. So here we have today with us very, very learned consultants who have been spending their lives across so many years helping people understand where and how they should be sending their children. Let's begin our session today. Mr. Harish Menon with us here. He is also a chartered accountant with over 18 years of experience into financial market. He's an investment advisor at House of Alpha Investment Advisors. He has been spending his life all throughout across financial markets, and he is here today to help us and guide us and understand if we plan to send our children abroad, how do we take care of the currency risk that today we are seeing between India and dollars, rather rupees and dollars, or how can we use the currency derivatives to hedge against this currency volatility. So thank you, Harish. We are looking forward to hearing from you and trying to cover our ass.
Vicky, for your kind introduction. Thank you, Darshak, for organizing this. Good evening to one and all in this session. My name is Harish Menon. I'll share a small presentation and take my points over the next 15-20 minutes. Feel free to put up any questions on the chat. I'll take it up at the end of this session. I'm the co-founder of a wealth management firm called House of Alpha. 4 of us came together last year to start this wealth firm, which we believe is doing a lot of things very differently. So we do everything from lifestyle financial planning to investment advisory to succession planning to distributing any logical products that would be useful for you. When I say distribute, recommend. And the most important part is we are fee-only financial advisors. We are not earning our fees through commission incomes or distribution income from the manufacturers. We take the fees from the clients, which is the client whom we are serving. And the benefit of that is there is a lot of transparency about how much you're paying and what value you're getting out of that. Also, the fees become negotiable beyond a point where the assets keep growing, but the services may still be the same. So we don't necessarily increase our fees beyond a point. So a lot of benefits of being fee-only financial advisors, which is a SEBI-registered business as such. Today, I will be speaking about the FX angle, which will come into picture if you are deciding to move out of India, either on an investment basis or if you send your child for foreign education, then obviously there'll be a lot of FX outlay involved. So we are essentially talking about whatever amount of investment or donation or fees is required to be paid in a foreign currency if you take up this option that is being discussed in this particular session. So if you listen to Bairo carefully, he mentioned in every slide for every country, what is the investment amount required, what is the financial outlay that will be needed. And one thing which goes without saying is all those amounts are required in foreign currency. We were not talking about Indian rupees to be given. We were talking about $800,000 in case of US or $150,000 for some other country or so on and so forth. So one of the things that sometimes parents or people who are planning to do something like this miss out is on the currency angle of the entire decision making. It is a financial decision making process, if you understand it. It is something that you will think through financially before you decide, apart from other factors considering do you want to give up Indian passport and all those things. So financially speaking, one of the things that unfortunately gets ignored a lot is the dollar rupee exchange rate movement. I use the word dollar rupee because dollar is pretty much the most important currency in the world as we speak. Whether you like US or not, whether your view about US is that they're a strong country or not, it wouldn't matter. What remains the fact is dollar is predominantly the most important currency in the world even today. Notwithstanding the recessions they have seen, notwithstanding the slowdown that they have seen after the 2008 crisis, it still remains one of the most important currencies in the world. If you see any international commodity prices, be it gold, be it oil, they all get expressed in dollar terms, not in euro, not in pound, not in rupee, not in yen. So while I talk about foreign currency risk, I'll be specifically looking at dollar because a lot of other currencies will move vis-a-vis how dollar is moving over a period of time. So example will include dollar rupee, but please understand it will apply to other currency pairs also, like euro rupee, pound rupee, depending upon which country you are planning to send your child to or planning to relocate. So the slides will be probably dollar rupee, but don't misunderstand. A lot of concepts apply to every other currency pair against rupee also. Now, before I proceed, whatever I say about Indian rupee should not be taken in a negative way, because whenever I speak about this topic of exchange rate, a lot of people kind of misunderstand the entire concept. There is a very common misconception that a stronger country logically means a stronger currency. I'll explain. A lot of people think that India as a country is doing very well. No doubt about that. We are among the fastest growing countries in the world. A lot of things are working for us. There are a lot of USPs that India has that many other countries in the world does not have from an economic standpoint. So we are more or less convinced that India as a country will do well over the next many years, if not decades. However, associate that logic and extend it and say, okay, if India as a country is going to do well, it means that rupee as a currency will also get stronger over a period of time, is a wrong correlation. A stronger country doesn't necessarily mean a stronger currency. That is something which you always have to keep in mind. I'll explain to you why I'm saying so as we go along, but one common misconception I want to break is that a classic example I can give you is of Japan. Japan is a developed country, one of the most developed countries in the world. Japan has very high per capita income, which means the national income per citizen in Japan is extremely high. Japan boasts some of the richest people and richest cities in the world. Yet, Japanese yen as a currency is very weak if you compare it against any other currency. In fact, if you're aware, Japanese yen is cheaper than Indian rupees also. 1 rupee will be able to buy more than 1 Japanese yen. So Japan is a more developed country than India. It is much bigger. It is much more richer, yet their currency is weaker than India. So just a simple example to explain to you that a stronger country doesn't necessarily mean a stronger currency. I'll tell you one more point. Just because our currency, let's say Indian rupees, is costlier than Japanese yen, it doesn't indicate that if you go to Japan, you will be able to buy goods and services very easily. So today, if you imagine, let's say 1 rupee is approximately, let's say 1.6 yen. Doesn't mean that if you land in Japan, things will be very cheap for you because Indian rupee is stronger. It doesn't work like that, because I don't know whether you've traveled to Japan. It is one of the most expensive countries in the world to go to. You will think a lot before you spend in Japan in yen. So it's not just a question of exchange rate that decides whether a country is cheaper or costlier. It is also a function of what is called as purchasing power of that currency. Thai baht. I'll take one more example. Thailand, a very popular destination among Indians, both for leisure as well as shopping, right? Any of you who have gone to Thailand or you know people going to Thailand, you will realize that a lot of goods that you see there are very cheap as compared to India. So a lot of them go to Bangkok or Pattaya, especially Bangkok from a shopping point of view, and they go mad. They go mad because the malls there are like, oh my God, there are so many things at so cheap price. But if you look at the currency exchange rate, Thai baht is stronger than Indian rupee. One Thai baht is more than almost 2 Indian rupees. So again, one example is Japan, the other example is Thailand baht. Exchange rates do not decide whether a country is cheap for you or a country is expensive for you. The first point I mentioned, a stronger country doesn't necessarily mean a stronger currency. Taking this as a basis, I am going to make a very simple statement that for the foreseeable future, rupee is going to continue to depreciate against most foreign currency, especially US dollar, euro, Great Britain pound, etc. If I take you to the history, this is the dollar rupee exchange rate chart over the last many decades. Just take a minute to understand what this chart is showing you. Starting somewhere in 1970s, $1 was less than 10 rupees. From there, it went to 20 rupees per dollar, 30 rupees per dollar, 40 rupees per dollar. There was a brief period in time around the 2008 crisis when there was a period where rupee actually gained against the dollar from something like 48 to almost 39. This was a very brief phase. After that, again, if you see, it has gone to 50, 60, 70. We have also touched 80. If you're aware, in the recent past, $1 has crossed 80. Also, we are close to 80 as we speak now. Now, again, I am not trying to belittle India. I'm not trying to say, oh, you are bad-mouthing India. I'm not. As I said, the currency rate does not reflect country's economic progress. A lot of political analysts would say, oh, this was all the Congress era where rupee depreciated. It doesn't have anything to do with politics or political parties or policies or anything. It has simply something to do with what is essentially called as purchasing power parity. Now, I don't want to sound too technical. What it simply means is, if you are trying to figure out how the exchange rate between two countries will behave. So let's take India versus US. There are two countries. Both have their own currencies, dollar and rupee. How will the exchange rate behave over a period of time? Let's say we are trying to forecast for the next 20 years, 10 years, 15 years. One of the most important factors that affects exchange rate is the inflation in those respective countries. Inflation, as you all know, is the rise in prices of goods and services. Now, if you are aware of inflation that prevails around us, India has an inflation of, on an average, over a period of time, 4 to 6% per annum. Currently, it is slightly more than 5 to 6%, but it will be in the range of 4 to 6% in India, a long-term average. In US, a general long-term average inflation is in the range of 1 to 2%. So India typically always has a higher inflation as compared to US. The reason for that is the state of economy. US is a far more developed economy. They started their economic development many decades before India did. We have just started our economic development in a big way. We are just at the cusp of probably the next 20-25 years where we will probably be the fastest growing country in the world. As a country is developing, as a country is continuing to grow with a lot of domestic consumption that is strong. If you're aware, India has a strong demographic population also, which means our age is much lower, the average age, as compared to many other countries. So as a growing economy, as a consuming economy, we will demand for a lot of goods and services, as a result of which our inflation will be higher. If our inflation will be higher as compared to other countries, it results into depreciation of our currency against other currencies. It has nothing to do with which country is better or worse. It is simply about inflation. So till the time you expect Indian inflation to be higher than dollar inflation, and I do see it for the foreseeable future to be the case, you will typically see rupee in a depreciating pattern as compared to US dollar. As this chart shows, from almost 7 rupees to a dollar, we have reached 80 rupees to a dollar, which is depreciation of rupee, which means the price of $1 is increasing over a period of time. If you ask me, again, I am very patriotic, yet the fact remains that we could see rupee further depreciating because India's inflation is still more than US and will continue to be more than US in the foreseeable future. Maybe 25-30 years down the line, when we become a very, very developed country in terms of per capita income, our demand may slow down. Like Japan. If you're aware, Japan's local demand is very, very low. Their economic growth is not driven by their local consumption anymore. So Japan is an example of a very developed country not growing fast. India is growing, so our inflation will be higher. A higher inflation results in more imports, basically. So if you imagine, there are two reasons or two major components India imports a lot. One is oil. If you're aware, we import a lot of oil because India does not have natural resources of oil. So 24% of total imports of India is crude oil. We import a lot of oil and obviously we need that for our economic development. The second most imported item in our import list apart from oil is gold. We import a lot of gold. And you know why we import a lot of gold? One of the reasons is lower prices in other countries. A lot of you might be aware that people go to UAE, Dubai, for example, and buy a lot of gold there. Why? Because the prices of gold there are kind of relatively cheaper than India. And it applies to a lot of other things like electronics and electric goods. It is changing for sure over the last 5-8 years, but the trend continues to be India has a higher inflation. We import a lot of not only oil, but a lot of non-oil products also. As a result, our imports are more than exports. This is called as current account deficit. You must have learned about some of these economic factors in your academics, maybe in school or college. Very relevant to know that current account deficit means the excess of import over export. So if you look at this data for the last almost 25 years, most of the times you will see what is called as deficit, which means we are having net imports. We are net importers, which means the demand for dollars is very high in India. There are only few quarters, just about 4 quarters over the last 25 years, where we were a net exporter, which means exports were more than imports. It's a very simple demand supply equation if you understand. If we import more than what we export, the net demand for dollars will be that much higher, putting depreciating pressure on rupee. So what I'm explaining to you is macroeconomic factors, and only macroeconomic factors affect dollar rupee over the medium to long term trend. And that is the reason why if you see the last 60 years of history and probably the next couple of decades, rupee will continue to depreciate against USD. If you ask me, I will not be surprised to see dollar rupee at 100 also at some point in time in the future. And please understand, this can happen in a phase where India is rapidly growing. Please understand. I can even debate probably a point that a weaker rupee is beneficial for India as compared to a stronger rupee. There can be discussions on that also. So I don't want to get into it, but the summary of what I'm trying to tell you in the last almost 7-8 minutes is, please be open to the idea that dollar rupee can become 85, 90, 95, 100. Now, if it doesn't touch 100, don't come back to me after 25 years and say it never touched 100. Maybe it touched 90, maybe it touched 95. What is the implication of all this in the conversation we are having? The implication is, if you're planning an investment in a foreign country, or if you're planning to send your child abroad or children abroad, if you have more than one child, you're talking about a dollar outflow, you're talking about a euro outflow. Let's take an example. Let's assume you need $300,000 for foreign education, which is $3 lakh. Now, at the rate of 80 rupees, you're talking about 3 lakhs into 80, 2.4 crores Indian rupees. That is the total cost you're talking about. But if the same 80 becomes 90, you're talking about 2 crores 70 lakhs now, which means there's a 30 lakhs impact. So on a $3 lakh outflow, every rupee is 3 lakh rupees extra that you have to shell out. Now I'll talk about something in passing later stage, but as of now, please be aware of the idea that rupee could depreciate. So if you have a child today who is, let's say, 12 years old, you think that there is an inclination of the child as well as your inclination is that he or she should study outside India. Maybe at the age of 18, he or she will move out. So you have 6 years. Today, dollar rupees 80. You're making a lot of calculation and doing financial planning, which is what we specialize in House of Alpha. We have to put all these numbers in perspective to see whether you have enough savings. Now, when you say do the calculation, you're like $3 lakh का cost है, 2.5 crore का खर्चा आएगा. That 2.5 crore could become 3 crores, 3.5 crores, maybe in 7-8 years if rupee has depreciated a lot. So when you do consider everything else, also consider a possibility that rupee can depreciate. Now, how do you handle this then? Now, if you take the fact that, okay, rupee can depreciate, how do you ensure that you are able to remit the foreign currency to a foreign country by not having too much impact of dollar rupee? The first is a very not so easy way of doing it, but you can try it. It's called timing the market. Same example, let's assume your child is 12 years old. You know that in about 5 years, most likely there will be higher education costs that will come in. So what you can do is you can keep watching the dollar rupee market. There will be phases, there will be months, there will be even quarters or even years where rupee will appreciate against the dollar. So let's assume you're doing all this when dollar rupee is 80. Now, yes, I am more or less convinced that it will go higher, but it may not go from 80 to 90 right away. It may probably go from 80 to first 75, and from 75 it may again go back to 90. So if you look at the chart also, it's not a straight line in which rupee is depreciating from 10 to 80. There are phases where rupee has appreciated also. If you see phases like this, if you imagine, look at these phases. This phase is where rupee has appreciated a lot. This was also a phase of a year or so where rupee appreciated. We have also seen multiple bouts of rupee appreciation. So one logic is you can try to time the market. You can say, you know what, I know I want $300,000 or $400,000 or whatever calculation education cost is, or investing outside for citizenship is, whatever the cost is. You can say, let me buy it over a period of time and keep remitting it to the foreign country. There is something called as liberalized remittance scheme, LRS. We only have a limit of $250,000 as of now that you can send outside India every year. Per individual, $250,000 is the max amount you can send outside India for any purpose, investment, education, whatever. So you can use that limit over a period of time. Every year you can use some of those limits and keep buying a lot of dollars when rupee has appreciated. So let's assume today it's 80. In the next 6 months, let's assume it goes to 77. It can happen. So you buy $50,000, for example, keep it. Then it goes to 78, 80, you at least got $50,000 at a lower price. If it goes to 82, 83, yes, you will pay higher, but at least some dollars you have got at a lower value. So that is one way of doing it, but obviously not very easy. You cannot do that in a very easy way because you don't know when the appreciation will happen, whether it will happen, etc., etc., etc. The second logic is applicable to those of you who kind of have come close to the point in time where your child has to be sent or you need to invest outside for citizenship. So now we have reached a point where, let's assume in about 6 months or in about 1 year, you will have to basically send your child or do the investment for a foreign country. Now, if it's only about 6 months or 1 year, what will essentially happen is you don't have too much time to time the market, because this could be a phase where rupee is continuously depreciating. So the safest from a risk management point of view thing to do is you just remit the dollars in one go. So you buy, let's say $250,000 at 80 and just remit it. Once you remit it, you need the money only after 1 year, let's say. You invest it in foreign currencies. You invest it in dollar bonds. You invest it in maybe equity if you want to take some risk and earn some returns on that. The benefit of doing this is at 80 you have purchased all your dollars. Even if it goes to 81, 82, 83, 85, 90, you will not be affected because you already purchased your dollars at 80. The side effect of this is if it goes to 77, 75, it can happen. There can be a phase of 2-3 years where rupee is not depreciating. In fact, it is appreciating. If that is your phase, you might look back and say, "Arey, thoda gadbad ho gaya because मैंने 80 में सारा खरीद लिया. Now the dollar rupee is at 77." But see, this is all wisdom in hindsight. This is only after a period of time you will know whether you did a good thing or a bad thing. If you want to keep peace of mind that I don't want to be affected by rupee depreciation, just purchase everything in lump sum, remit it to whichever country you want to remit it to, or you can just remit it to dollar because from dollar you can convert to any other currency. Invest it in US bonds or US mutual funds or ETFs, etc. You can earn some returns also out of that. That way you can achieve your FX cost of funding. What we recommend in House of Alpha to all our clients, we have a lot of clients who are exactly in this scenario where they have to invest in a foreign country, and we are financial planners, we are investment advisors. My job every day is to look at the markets. What we prefer is to do what is called as use of currency options. It's something called derivatives. We have something called futures and options that you must have heard about probably. We have options in dollar rupee, euro rupee, pound rupee. We have these currencies where you can use options. I don't want to go into technicalities of options. If you want, we can discuss it later. But option works like an insurance product. You pay an upfront premium. Let's assume you are looking to hedge. Hedge means protect any further depreciation. You don't want to be affected by further depreciation. Dollar rupee today is, let's say, 80, just round figure. You are not willing to pay more than 80. So what you can say is, you can pay a small premium and get an option where you can buy the dollars at 80 at any given point in time over the next 1 year or 2 years or 3 years. You can just freeze that rate. You can say, you know what, even if it goes to 85 or 90, I don't care. I will get my dollars at 80. You can freeze that 80 by paying a cost. The advantage of doing this is, if you freeze the cost at 80, no upside will affect you, which means if it goes to 85 or 90, you will not have a problem. You will still pay 80. Further, if it goes to 78 or 76 or 74, you don't have to pay 80. You can say, I don't want to buy it at 80, I'll buy it at 74 or 75 or 76, which means you get the best of both worlds. If rupee depreciates, you're protected by it. If rupee appreciates, you get the benefit of it as well. The cost of this option that you have to pay upfront, it's like a medical insurance premium. You're paying an upfront cost and protecting yourself for 1 year. So if something happens to you in 1 year, you will be reimbursed. But if something doesn't happen to you, it's okay. The premium will not be refunded. The premium that you pay for currency option will not be refunded. The net cost, and there are multiple ways in doing it, effectively will come to approximately 2 to 2.5% per annum. You will pay something like 2% per annum to hedge all your rupee depreciation and also keep the appreciation benefit. So it's a best of both world kind of situation. If you use option number 2, where you remit everything at 80, of course, depreciation will not affect you. If it goes to 85, you are not affected. But because you purchased everything at 80 already and you remitted, if it goes to 75, you don't get a benefit of it. In the third option, if it goes to 75 in 6 months, you can actually buy the dollars at 75 and not at 80. But if it goes to 85, you can still buy it at 80. So it's like you're kind of playing on both the sides. You will have to pay a cost there, which comes to about roughly 2%. There's a lot of ways in which you can do that. That's where our expertise comes in. So that is how you can take care of the FX angle of any decision that involves foreign currency. So it could be investing overseas, it could be foreign education, it could be getting a citizenship of some of those countries that you heard about in the initial part. That's how you can do it. We specialize in that. I'll be very happy to take questions at this point. Over to you, Nikki. I hope I did not take too much time.
No, Harish, that was superb. And you have actually provoked a lot of questions among us. We have a couple of questions in the chat box and otherwise as well. So I'll quickly take up one by one. There's one question which is saying, what is the strategic plan you suggest from investment perspective if my son is planning in near future or someone who is 10-12 years later? I think you've already answered it in your explanation.
I'll quickly still talk about it if you don't mind.
Sure.
What I would suggest is a strategic portfolio that you create where you can invest 70-75% in Indian rupee terms, because India will appreciate in terms of equities, for example. So you can invest in equity markets in India, a good part of the portfolio, and 20-25% you can build a dollar portfolio using US mutual funds, US ETF, so that you're building a dollar kitty also for a future dollar expense that could be 10-12 years down the line. Because it is 10-12 years down the line, I wouldn't recommend you to take everything to dollar, because no matter what, Indian equity will give you more returns than US equity. So you can build a good investment portfolio for 10-12 years. Every year remit a little bit to dollar and take care of your foreign education cost.
Correct. In fact, Harish, we have also seen a lot of inquiries and a lot of people investing in US companies, listed company shares and securities. That's really on a rise. At the same time, that brings me to the next question: is if you can just draw attention on a couple of instruments which you can use for investment in dollar terms.
If you want to play it totally safe, then a debt mutual fund in US would be the best option. Just like you have fixed income mutual funds in India, you have fixed income mutual funds in US as well. That would be like totally safe. Your capital will be protected totally. You will get returns in the range of 3 to 4% per annum over a period of time. Currently, it's a little more than 3%, but it can even be 2. So on an average, I would say 3 to 4% without much of a risk to your capital. If you're investing for a long period of time, I'm saying more than 5, 8, 10 years, then you can create a portfolio which also has equity. You can simply purchase a US index fund, like a NASDAQ fund, for example. Like you have Nifty and Sensex in India, which are indices. You can simply purchase the NASDAQ index. Tech companies largely is in that index, and US tech tends to do well over a period of time. So you can simply purchase those equity indices and create a simple long-term portfolio which will not only appreciate in returns but also take care of your future dollar funding amounts.
Perfect, Harish. There's one more question which says that in your lecture you mentioned that you should buy dollars in bits and pieces and hold them if you want to, invest in the near future. The question is that they've heard that bankers do not allow you to hold it for more than 6 months. So how do you buy and keep?
So under the liberalized remittance scheme, as I said, $2.5 lakh can be remitted outside and invested outside. You will not be allowed to buy dollars and keep it in India. That is not allowed. I'm not talking about keeping it in a FCNR account or a NRE account in Indian banks. I'm saying remit it from India, go through your banker or any other platform, open a mutual fund account in US, invest it in the mutual fund there. So automatically it will not have any restriction of holding it for 6 months only. 6 months is for specific foreign currency that you have earned, which you're keeping it in Indian banks.
Fair enough.
There's no restriction.
Manavta Pinchal is asking, can we do a forward contract for currency, and is currency option work like a forward contract? Can you give an example with some numbers?
Sure. So Manavta, I'll give you an example with 80 rupees as the spot rate. So currently dollar rupee, let's assume is 80 rupees. A forward contract is a derivative instrument. It also is in the form of futures. So forward you will do through a banker. Futures you will do it on exchange like National Stock Exchange. When you do a forward contract or a futures contract, the logic applies to both. You can buy dollars for a future date. So you can go up to 1 year. So up to 1 year future, you can purchase the dollars and freeze the rate. That rate, by the way, will not be 80. It will be higher than 80. It will be close to 3.5% higher than 80. There is something called as forward premium. So if you want to buy it in today's market, it is 80. But if you want to freeze it at 80, but you will buy it only after 1 year, you have to pay the interest cost on that, which will add another 3 to 3.5%, which means the same 80 you will probably buying at 82. So if you do a forward contract at 82, 82 is frozen for you. Now after 1 year, whether exchange rate is 90 also, you will get your dollars at 82. But you're frozen it at 82, which means if the dollar rupee is at 75, you still have to pay 82 for your dollar rupee. What option will give you is an added advantage. Option is not like forwards or futures. In option, you pay a premium, which again will come to that 2.5% only. But the benefit of paying that premium is if 80 goes to 90, you still pay 80. But if 80 goes to 75, you pay 75, which you will not get in the case of forward, because in forward, you will freeze the 82. Whether exchange rate goes to 75 or 90, you will pay 82. That's the difference between forwards and options. I'll prefer option for multiple reasons. It is very flexible. You can decide when to buy and not to buy. You can play around with that. So with a lot of our clients, we have done cases where we hedged it using options. We did not end up paying any cost. In fact, we got some returns on it. So there are ways of doing that also. What I mentioned of 2.5% is if you don't do anything, that is the cost. But if you're in the market, like somebody like me, I can do something out of that and make the net cost closer to zero, or even get a net income out of the entire picture. You're welcome, Manaka.
Thank you, Harish. We have Chetan Roy here, and I believe he wants to ask his question. Chetan, you can unmute yourself and...
Yeah, can you hear me?
Yes, Chetan, please go on.
Yeah, thank you, Harish. Just two questions for you. First question, you talked about the currency rates, the Indian currency rate depreciating. I just wanted to ask you, get your thoughts around the change that we're seeing, right, in terms of the global, the whole thing around the US no longer becoming the central currency for trading, right? We're seeing it's begun to start this year post the Ukraine war. Do you see that taking flight, and therefore the whole appreciation piece may not be the way that it's been in the past, because dollar no longer is the central and the only form of currency for global trading? That's one question. And the second question I had is that, have you by any chance done any analysis about the returns, say, in the Indian market versus inflation, and the returns in the US market versus US inflation? If you look at that over a period of, say, 20 or 30 years, has the US given better returns because the inflation rates are much lower? Or has India given better returns because the India growth is much higher? I'm just curious whether you've done that study at all.
Okay, so I'll take the first question first. So there are two parts to that first question that you asked. One is, do I believe the supremacy of US dollar is reducing, given, as you rightly said, a lot of things that have happened this year? To some extent, yes, because of cryptos, because of alternative currencies, because of Russia and China almost saying that we can trade in other currencies also. To some extent, yes, but not to a very large extent. I do not see any major transition happening where the world will go beyond US dollars in a big way. It will only be small changes here and there. For example, as we speak today, dollar is one of the currencies in a currency pair which is getting traded in the world in more than 83% of global dollar volumes globally. Which means in every currency market, if you're seeing the trading happening, dollar is one of the two currencies in more than 80%. Now that may probably become 75. That's about it. I don't see a major change where dollar will be replaced with a pound or a euro or a crypto. And there are fundamental reasons for that. The fundamental reason is, if dollar is replaced with any other currency, that any other currency will become what is called as a reserve currency, which means central banks of Saudi and central banks of China and Japan and India would be holding a lot of FX reserves of euro or pound or yen for that matter. Now, these countries don't issue that many government bonds where all these reserves can be invested into. So why we like dollar is not because it is an important country or it is growing. Nothing. Dollar has been in recession for multiple years, as in it has seen the highest number of recession over the last 50, 60 years. There is no choice. It's almost like saying no alternative when we vote for certain political parties in India. Same logic. There is no choice. So, I don't believe that dollar supremacy is going to change big time. Second point in the same logic is, even if dollar supremacy is going to change globally, it may not still impact dollar rupee exchange rates behavior, because when I said rupee is depreciating, the logic was not dollar is an important currency. The logic was not dollar is supreme. The simple logic was our inflation is more than US inflation. So as long as our inflation is more than US inflation, Chetan, I don't think you will be able to prevent rupee depreciation. You can change the rate of depreciation. You can change the number of years in which it goes up by 10 rupees, but I don't see the trajectory changing, at least for the foreseeable future. Coming to your second questions about returns versus inflation, I just want to clarify, were you talking about equity returns?
Yeah, I mean, okay, let's take equity returns. Yeah, let's take equity returns. That's probably the simplest one. Maybe the S&P 500 versus the BSE growth or whatever. Simple index-based versus inflation.
So if you take it from point to point, let's say I take for the last 25 years, for example, then the net dollar returns, I'm just comparing dollar returns in investing in US versus investing in India, the net dollar returns is higher in US. In other words, even if Indian equity in a nominal term has done well, rupee has depreciated so much that in dollar terms, it eats away your returns. So the net dollar returns are still higher in a US context.